My friends, good day. Lately, a lot of trading platforms have been literally scamming their users. I'm going to tell you something without mentioning any names. I'll tell you a little bit about what's going on. We're going to have to go back a little bit, but very quickly, you'll see. Let's go back to 1602 at the beginning of the 17th century. So during the 1500s, there was an East India Company. It was a company based in Amsterdam. It was a Dutch company. And then to finance its expeditions, which were very expensive and sometimes even risky, well, what they did was sell shares. They sold shares to people, they brought in money. And then, of course, those people hoped that the expeditions would be successful. They did this once a year. Now, people sometimes, they buy shares, but during the year they need money, so they need to sell them. There was this need among shareholders to be able to trade their shares throughout the year. That's when, in 1602, we opened the Amsterdam Stock Exchange. It was the first organized stock exchange in the world, and it only sold one security. It was the share of the Veronique de Oostindische Compagnie, East India Company. So, what was happening? In there, we had a guy with a big ledger. People would come to him and say, okay, I want to sell shares or buy shares. So he would enter it in the ledger. How many shares were transferred from one person to another? But the company itself didn't know. It was only at the end of the year that the register was brought to the company. And that's when the settlements were actually made. So what's going to happen? Well, it's going to go on normally until a guy named Isaac Lemaire comes along. Isaac Lemaire is from a family that just moved to Belgium. So, I don't know if he has anything to do with Mr. Lemaire, the Mozart of the French economy, whom the whole world envies France for. Well, Mr. Lemaire had a problem with Vogue, with that company. He was a major shareholder there. Later, he had a falling out with them and everything. And then he started doing something strange, actually strange for that time, but it's normal today. He started selling shares he didn't have, especially since he had heard about a French company that was going to head to the Indies and would probably take some market share from the Veronique de Oostindische Compagnie. And since he didn't like the Veronique de Oostindische Compagnie at all, he thought they were going to fail. On their reckless expeditions, they're going to get eaten by cannibals, their ships will sink at sea, and their stocks will plummet. So what did he decide to do? He went to the Amsterdam Stock Exchange and sold shares. And actually, he sold shares he didn't have. He sold short. This is the first documented case of short selling. That means selling shares or selling assets that you don't necessarily have on hand. So, Mr. Isaac Lemaire, every day he would go and sell until it caused a panic. Because this put pressure on the price and the other shareholders started to panic. So Mr. Lemaire almost brought down the Amsterdam Stock Exchange. And that's why, around the year of our Lord 1508, 1509, the Dutch state had to step in and start banning short selling. Of course, that won't endure. But it was the first documented attempt by a state to regulate the stock market. Today, the stock market is regulated by countless documents, regulations, and laws. Well, now, what I'm trying to tell you is that from the moment we created a stock market with a lag, you can see that the book, the ledger, was out of sync with reality, with what the Veronique de Oostindische Company actually had. Well, we created opportunities for speculation. We created opportunities to make money out of nothing. Okay, we're going to get to today very quickly. Let's take a platform. I'm not going to name any names once again. Let's take a platform. Well, if you create a platform, what's going to happen? At first, let's say you have only one client. So the client puts in money. He's going to buy, let's say, a Bitcoin. Okay, you take his money. You go to the market to buy him a Bitcoin. When he wants to sell it, you sell it, and then you put the money in his account. So far, it's simple. But be careful. Once you start having dozens, hundreds, thousands of participants, thousands of clients making transactions all the time in every direction, You don't have to do that anymore. You don't have to be in real time with the market. Let's go back to 1602. What are you going to do? You're going to do this. 1602, not 1502. I'm not sure what I said before, but 1602 is my final answer. Jean-Pierre, so as I was saying, we have the following situation. You start doing compensation between the clients. That is, someone gives you money, they want to buy a Bitcoin. Okay, you take the money, you put a Bitcoin on his interface, you don't actually buy it. Why? Because sooner or later, maybe even in 3 seconds, you'll have someone else from your same platform who will want to sell a Bitcoin. So you just have to create a swap between the two. You make a quick exchange between them, bam, bam, an internal settlement. So you write that this one needs a Bitcoin. You gave it to him virtually. And then at some point when someone wants to sell, well, there you go. You take from here, you put it there. And after a while, you can end up in a situation where you have a good portion of your buyers and sellers, your clients, well, that they don't have positions that are real, that are reflected on the market. They only have positions in your own books. And you have an increasing gap with the market. So, of course, you do this because it's convenient, because it's simple, because it allows you to be fast, to save on costs and all that. You don't intend to scam anyone from the start. Now, what problem can arise? We can have the following problem. Listen to this one. You assume that every time there's a buyer, a few seconds later, there's a seller, and vice versa. So there's statistical balance. You have thousands and thousands of clients. Well, that's it. Things are moving in all directions. There will always be a way to offset between two clients. But here's the problem. Imagine that suddenly some really bad news breaks in the media reports. And within a few minutes, most of your clients are heading in the same direction. For example, they want to sell. But the problem is you're stuck. They want to sell assets, but there are no buyers. And then they want to sell assets. Suppose someone wants to sell a Bitcoin because he believes it's collapsing. But the problem is he doesn't really have it. The Bitcoin is virtual. Well, when he bought it, you put it on the interface for him, hoping to settle it at some point, but you haven't settled it yet. So you're stuck. He wants to sell a Bitcoin, but you need money because you have to give him money if he sells, but you never actually bought the Bitcoin in the first place. So you end up in a tricky situation without ever having wanted to scam your clients. You're in a situation where you can't offset the actions of some with the actions of others. So what will you do? You'll lock access because you have no choice. Otherwise, it's bankruptcy. What do? You're going to stall. You're going to say, sorry, everyone wants to do the same thing. Our platforms are overloaded. We can't log in and the interfaces are frozen. And then you wait for things to calm down. You wait for the storm to pass. You keep your head down because everyone wants to do the same thing. So that's the first layer, let's say, of disconnect between you and the market. In this first layer, as the house, as the casino, I want to say, you're not aligned with the market. You have a gap. Everyone does, even the banks. But the worst that can happen is when you start to abuse that gap, and then what's in your books and what's on the market is really too out of sync. And suddenly there's a sharp movement, and at that moment, it's a disaster. You can't do what you have pending anymore. It's ruined. Well, no. Here's another layer. And here we're really getting into... So I don't know if this is really illegal, but, well, we're in a gray area now. Look, you have a client who wants to buy a Bitcoin, let's say, or any other crypto. So Bitcoin, to keep it simple. He wants to buy a Bitcoin, but you, as the house, you have a view of the whole market. You have a view of all your clients' actions. You know what everyone is doing. So this guy, he wants to buy a Bitcoin and you think, yeah, but he's making a mistake. That's not possible. Everyone is a seller. Algorithms are made to show this in real time, stating everyone is a seller. So the consensus is that the price is going down. And this guy, what does he want to do? He wants to buy, well, he's making a mistake, obviously. So what are we going to do? We're going to give him a virtual Bitcoin. So we'll put that on his interface and we take his money. We'll see later. What will we do then? Later, we'll buy him the Bitcoin at a lower price on a bear market. Suppose he bought it for, say, 100,000 euros. If in 2 weeks we can buy it for 90,000, well, we've made 10,000 in the process, the client won't notice a thing. So in that case, you start building the house. And there are a lot of companies that do that. I've seen it. There are many where the company starts to take positions, opposes its clients. That means it stops being a neutral operator. And now it becomes an operator that makes money when its clients lose and vice versa. That loses money when its clients win. And at that point, we literally get into manipulation techniques. Why? Because by playing this game, the clients are slow while they are quick. They shorted, whether it was gold, crypto, or stocks, it didn't matter. At that moment, the market suddenly moves. The client who bought his Bitcoin, let's say he bought it for 100,000 euros and is happy to see it on his screen. Suddenly he thinks, it went up, I'll sell and take my 5,000 euros profit now, and clicks to sell. But now you're in a tough spot because the company, the house, the firm is short selling Bitcoin. They took the money, put it on their platform, but never made the purchase. So if he sells it at a higher price, they're forced to credit him 5,000 euros. Where does she get the 5,000 euros? She takes them and will lose them, you see? He paid 100,000 euros for one Bitcoin and now wants to sell it for 105,000 euros. It's very annoying for them. So what are they going to do? When he wants to sell, they're going to freeze the transaction. At that point, they'll say, error number 6,550, contact support, try again later. So you have the guy who will keep trying. After bam, session ended, can't log in, try again later. He spends hours writing support, chatting, and tweeting. Afterwards, he manages to reconnect, and it's too late. It's gone. There you go. The opportunity has passed. I have a friend who went broke in the United Kingdom doing that. That means he noticed, and I noticed with him, that every time he had a winning position, it couldn't be executed. Winning positions never went through, but losing ones executed immediately. That's a very important clue when you're with any operator. And when the trades where you're losing get executed right away, and the trades where you're winning can't be executed, it means they're doing that and playing against you. They're hedging with their own book, and it's actually over-hedging because they're playing against their clients. And at that point, when you're in that kind of mindset, whether you bet on the downside or the upside, you lose either way. Why? Because the house is playing against you. You lack a neutral intermediary. Instead, you have one who tries to outsmart you. They'll counter you with algorithms and fake technical issues to block you, no matter what you do. So there you go, my friends, especially when you're trading and every minute counts, every second counts. They know if you want to sell, they'll block you. Then 3 minutes later, it's over. So sell if you want. But now it's dropped. See what I mean? It's really dangerous. There you go. It's a situation where everyone is getting wiped out. $500 million have recently been taken from people's pockets. Fortunately, my friends, I won't hide it from you. I wasn't into crypto at all. It's been a long time since I got out of all that. But I observe, and I'm quite shocked to see what's happening. In particular, I personally suspect the Trump clan, his family, his son, and those close to him of being behind these manipulations, like savages, insider trading. There you go, my friends. Be very careful, really, because between theory and practice, there is always an extremely wide gap, and it's getting wider and wider today. See you in another video. Sorry for the noise. See you in another video. And please take good care of yourselves. Times are tough. See you very soon.